All right, good afternoon, guys. Let's start your revision questions. So let me start with question number one. So the question number one is on financial instruments. It says Tesla Limited issues 5,000 convertible notes. Notes have a 3-year term and are issued at par with a face value of $1,000 per note, giving total proceeds at the date of the issue of 5 million. So guys, a few things to take note here. First, face value of these notes is 5 million, which is given in the question. Now since these notes issued at par, that's how much they receive on the issue date. It's $5 million. Okay, now guys, you're given two rates. It says notes pay interest of 5% per annum, and the market rate for similar conversion options is 9%. Right. So what is the coupon rate? Now, coupon rate is the rate in which the company borrows money at. It's 5% per annum. So this is the coupon rate. Now, if you're not sure as to what is the coupon rate, the trick is always take the low amount. So this is the coupon rate in this case. See, 9% is greater than 5. Yeah. So this is the coupon rate and you work out the coupon payment. Okay. Right. Let's start part A. Now, it's guys, in the exam, you will be given the present value factors. So the present value of $1 annuity over 3 years at 9% is this amount, and the present value of $1 lump sum in 3 years at 9% is this amount. So these two factors will be given in the exam. Now, which factor do we use to work out the present value of coupon payments? We use this. Since coupon payments are made every year, it represents an annuity. Yeah, so this is the present value factor, 2.53. Okay, so let's start part A. Prepare the journal entry to record the issue of convertible notes in accordance with the requirements of ASB 132. So let's work out how much, let's work out the present value of coupon payments and the present value of the lump sum payment in 3 years. Now that gives you the present, that gives you the liability component of the convertible note. Okay, let's start. So guys, this gives you, let me go through this one by one. Okay, right. So what is a coupon payment? So the face value is 5 million. What you need to do is you take the lower interest rate, 5%, to determine the coupon payment. So 5 million times by 5% gives you 250. That's a coupon payment. Lovely. So what is the liability component of this convertible note? So you take 250,000 and you multiply that by the present value factor for annuity. That's how you get the present value of coupon payment. That's what you get. And then you work out the present value of the face value. Remember, this $5 million will be paid at the end of 3 years. Okay, so that represents a lump sum in 3 years, which means we need to use this present value factor. That gives you 5 million times 0.777. Okay, so you take the sum of 632,824 and 3,860,917. This is the liability component, guys. This is the liability component. Okay, now the convertible note has a face value of 5 million. So what is the equity component? Okay, so the face value is 5 million, which means you need to minus this liability component from 5 million. That gives you the equity component of the convertible note. Okay, on the issue date, how do we record the journal entry? So the journal entry represents cash receipt. So they receive $5 million on the issue date. Okay, So you debit cash at bank $5 million, and then what do you credit? You credit this liability component. You write convertible note liability for $4,493,741. And then you credit the equity component, which is $506,259. There you go. Right. Okay, let's play with the table now. So we know the liability component. We use this liability component to work out interest expense and interest paid. Okay, so for the year ended, now on the inception, at the inception of the note, convertible note liability is $4,493,741. That is a convertible note liability, which is at the inception. Okay, now guys, how much interest they paid? Now interest paid means the coupon payment on the convertible note. Now what's a coupon payment? So coupon payment is 5% times 5 million. 5% times 5 million, which gives you $250,000. So this is the coupon payment. Okay, so 1st of July 30th of June 2016, coupon payment is $250,000. Now how do you work out the interest expense here? Interest expense on the convertible note. Okay, right, now we take the market rate, which is 9% per annum, and you multiply that by the convertible notes liability, which is $4,493,741. Sorry, give me a minute. Let me fix that up. There you go. So what you get is $404,437. Now guys, what's the difference? It's $404,437 less interest paid. That is the difference. There you go. Which means the liability increased by $154,437. You need to add that $154,437 to the convertible notes liability. Let's stop this. That's what you get. $4,648,178. All right, for the year ended 30th of June 2017, coupon payment remains at $250. Now, what's the interest expense? Okay, you take this liability, which is $4,648,178, multiplied by 0.09. It's 9%. That gives you the interest expense. There you go. And what's the difference? It's $418,336 minus $250. There you go. So the liability increased by $168,336. And this is the convertible notes liability at the end of 30th of June 2017. All right, 30th of June 2018, coupon payment remains the same. What is the interest expense? You take this liability, multiply by 0.09. There you go. And what is the difference? 433,486 minus 250. So the difference is 183,486. If you add this back, you should get 5 million. There you go. It's complete. Okay. Now, guys, let me repeat the excuse me. Let me repeat the first entry we did on 1st of July 2015 at the inception of the note. On the issue date, they received $5 million. Convertible notes liability is $4,493,741. Convertible notes option, which means these holders have the option to convert these to either equity. Which is worth $506,259. Now, guys, part C asks us, okay, if the holders do not exercise the option and the note is repaid, which means they don't exercise the option, which means this note is not converted into equity. Okay, which means the note is repaid at the end of the term. Okay, so let's start. On the 30th of June 2016, what do you have? All right, on the 30th of June 2016, they paid $250,000 cash. The interest expense is $404,437, and their liability increased by $154,437. So let us begin that entry. There you go. Hold on. Yep. They paid $250,000 in cash. Convertible notes liability is $154,437. Yep. 30th of June 2016. 30th of June 2017. They paid $418,336. Sorry, they paid $250,000. Interest expense is $418,336. Difference is $168,336. That's how much the liability increased by. There you go. 30th of June 2018, we do the same. Yep. Guys, since the holders don't exercise the option, this $5 million is repaid in cash. So you debit convertible note liability, credit cash at bank. There you go. All right, guys, for parts, sorry, is that part C? Yeah, part C number 1. Guys, so part C number 2, holders exercise the option and this note is converted into share capital at the end of the contract term. So all other entries are the same. For example, 1st of July 2015, it's the same entry, you receive cash. 30th of June 2016, it's the same entry. 30th of June 2017, same entry as before. 30th of June 2018, same entry as well. The only difference is on the 30th of June 2018, the note is converted into share capital. That's what you see here. All right, guys. All right, so that's question number 1, and let me go through question number 2 in the next video. See you soon.